Hi there, Adam Gower here, and welcome to this week's podcast with guest Chris Finlay, Chairman and CEO at Lloyd Jones, an institutional private equity company in Florida. So this topic, institutional quality, is a big deal because it is a concept bandied about a lot in real estate crowdfunding, and in many cases is actually nothing more than a veneer that sponsors use without any substance. Stretching a bit for an analogy, to say you have an institutional quality deal without all the following components is a bit like someone who doesn't know how to drive a stick shift telling you they have a Formula One car. Big deal. Won't get you anywhere. Simply stated, institutional quality real estate does not just relate to the real estate itself. It relates to the way the deal is underwritten, the due diligence that goes into it, and the sponsor and partners involved in the deal. By this standard, my guest, Chris Finlay at Lloyd Jones, is definitively an institutional quality sponsor. As you'll hear today, Chris has a lengthy career. Traditionally, he's only raised capital from institutional investors and is now moving into the real estate crowdfunding world. This, to me, is the greatest way to mitigate risk in real estate as an accredited investor. If you can invest with a company like Lloyd Jones who bring in institutional partners that you can invest alongside, and those partners, by definition, those partners have gone through intense due diligence, as you'll hear from Chris today that they do, then you can rest assured that a sophisticated team of analysts have underwritten the deal and checked the sponsor's work product. Of course, this doesn't mean that you eliminate risk, but in real estate, this is about as close as you're going to get to mitigating it. To find out more about Chris and Lloyd Jones, go to the podcast page at gowercrowd.com. While you're there, be sure to click on the news link in the menu at the top of the page. You'll gain access to the only news channel that is exclusively dedicated to real estate crowdfunding, where you're going to find a mass of information that you can immediately use, from news to education to access to every crowdfunded deal on the market. It truly is the motherlode of real estate crowdfunding information and education, all there at gowercrowd.com. Okay, without further ado, it is my great pleasure to introduce you to my friend, Chris Finlay, Chairman and CEO at Lloyd Jones. Here he is.
Chris, what a pleasure having you on my show today. Thank you so very much for joining me. Now, where I would love to start, we've actually had this conversation before, you know. You are a major institutional player in commercial real estate over there in Florida. And here we are in this incredibly hot market. I've never seen, in fact, it was you that told me rents in Miami are going up 2% a month. Unbelievable. So where, Chris Finlay, Lloyd Jones, where are the opportunities in this market?
Well, that's a great question, and I think it's extremely tough to find a great opportunity in multifamily. We were talking specifically on the multifamily asset class, and it is, as you mentioned, just incredibly hot. Especially South Florida. South Florida has had a mass migration from New York City. All of the big private equity firms in New York have now opened offices in Brickell and Miami Beach. It's just crazy. And it's having such an overwhelming impact on residential that I've never seen anything like it. I mean, in some cases, our folks here, when they go to renew their lease, the rent is 50% higher than the previous rent. 50%.
Incredible.
And that's not unusual. I mean, this is becoming almost the standard, and in some cases, it's even higher than that. So it's just amazing, and I think this is certainly an extreme example because I think COVID drove a lot of companies down here. But it's happening throughout, just about every market that we look at in the Southeast and Southwest is just doing unbelievably well. The multifamily asset class is just doing tremendous. And I think part of it also is that, there's these huge investment asset management firms out of New York and Chicago and other places, and they've just raised such a huge amount of cash that they're making investments at yields that don't make sense to me. It may make sense to them, but it doesn't make sense to me. So it's just
what kind of yields are you seeing people?
3.5 cap. A 3.5 cap is normal, right? So that's like a normal deal nowadays. And you used to hear about that in LA or San Francisco or New York for super trophy properties, right? Now 70s vintage is selling for 3.5 cap in Orlando. Okay, so I mean it's just incredible. So their yields are their threshold yield, and a lot of these are non-traded REITs that have raised this enormous amount of money. And those non-traded REITs have to get it out, and they're basically projecting a 5% yield. So if they can get their investor a 5% yield, they're happy, right? So so their cost of money is so low. As long as they get to an overall 5% yield, they can accomplish that. For me, a 5% yield is most of our investors want 7-8% yield, somewhere in that range. 5 years ago, it used to be 10.
Right. And now your investors, they're all, and we'll talk about crowdfunding a little bit later, but historically, your investors are all institutions, aren't they?
Mostly institutions and billion-dollar family offices. And these billion-dollar family offices operate like institutions. I mean, they have their own investment teams. They have their own chief investment officer, boards, and so forth. So they're very, very sophisticated investors. And these guys are putting out 300, 400, 500 million a year for one individual that's the patriarch of that family, right? So, and in many cases are worth multi-billions. So they're very sophisticated, if not more sophisticated than the institutional guys in New York. Very, very sharp guys.
And to what extent do they double check your work product when you offer them a deal?
Believe me, they dig deep, and they have resources that you can't imagine. They have super high priced talent working for them. They have no hesitation to call on the best consultants anywhere in the world. So these are very, very sophisticated investors. Believe me, they dig, they uncover everything. And it's good. I mean, they just, for us, it's like answering 1,000 questions, but that's what we have to do.
And we'll talk, I want to get back to this again a little bit later, Chris, when we do talk about crowdfunding and the intersection for Lloyd Jones between the institutional investor and crowdfunding as well. So I think there's a tremendous opportunity there for everybody all around. And we've talked about this. We'll bring it up again in a few minutes. But before we do, with this explosion, the first thing I have to ask you when you talk about this compression of cap rates, multifamily, and it's not just Florida, it's the Southeast. As far as I can tell, it's nationwide.
Yeah.
I think of real estate at the moment as being flat earth. It's kind of a crazy term to use.
Yeah.
But it's like cap rates in every asset class, in every city, in every location are all being pushed down, right? Cap rates and prices are just going up through the roof. When you talk about 3.5 caps, multifamily, it's not unusual to see those across the board in all asset classes. It's really incredible what I'm hearing from our clients. So I have to ask this. My first question, what are the opportunities? But before I ask that, you've been through this a few times, right? You've been in this business multiple cycles. How concerned are you that we are moving towards a collapse? I mean, is there too much liquidity in the market? How do you play the game at this in this market?
Yeah, that's a great question. I mean, we've been in business 42 years now. And, the first major downturn occurred in 79, the late 70s, early 80s. massive, you know, the S&L crisis, and it moved up into the commercial banks in the Northeast and so forth. And during that time, we became a very large asset manager for the FDIC in the Northeast, one of the top. And, you know, and there you saw such a collapse in values. And it really was a government decision that caused that. So in those days, they required the banks to mark the assets down to liquidation value, right? So then we come along in the 2008, 2010 recession, when we have the explosion of, you know, the primarily single family mortgage debacle and all of that. That didn't have anywhere near as bad an impact on real estate, primarily because the feds allowed the banks to extend and pretend, right? So as long as you were paying the mortgage, even though the asset was probably worth less than the mortgage, the bank didn't have to write it down as long as you paid and paid on time. So it you know, it certainly got hit, but it didn't get hit anywhere near. So now we're facing a situation where there's such a huge amount of capital. It's just not the institutions, it's the federal government creating capital. And I mean, this is an uncharted territory. I mean, this is so massive. The trillions of dollars that the Fed is printing, you know, on a regular basis. I mean, it's just, you know, what is it, 16 or 17 billion over the past year? I mean, trillion, right? 16 or 17 trillion dollars over the past 18 months. And you ask, am I scared? I mean, you know, I think you have to be careful. You really have to be careful. And you know, and I know, you've been around a long time and seen this. Careful means leverage, right? If you are not stretched on the leverage and the price comes down and you can still survive, it always comes back, right? It always comes back. So the key that we're trying to do is just this is not the time to put pref equity on, mezzanine debt, lever the damn thing up to 80, 85, 90%. That's crazy. You're just, you know, because there's going to be some correction here sooner or later. There has to be a correction here sooner or later. There's no question in my mind.
So where are the opportunities? And I know you've tapped into some really incredible ones. Tell me about it.
Well, senior housing is, to me, the best opportunity out there right now. The absolute number one opportunity. The reason being is we have a demographic, an overwhelming demographic tsunami coming at us of old people like me. And sooner or later, they're going to need to go into a senior housing facility, whether it be an independent living, which is where you go to have fun, right? And you don't have to cook and clean and all that stuff, and you meet people and you party all the time. And then, you know, it goes from there to assisted living and memory care and further as you need more help, right? So that business is just, I think, two things. We felt in 2019, we purposely decided to focus on senior living and make that a strategic decision for us moving forward. Then, of course, COVID hit, right? And it came to a complete standstill. So, you know, here we were ready to, you know, to execute on the strategy. COVID hit us, and then bingo, things shut down until probably 6 months ago. Deals started coming back on the market, and we've got 5 deals that are closing here before the end of the year. And you know, these are deals that you're buying at 7.5, 8.5 caps. Class A properties, great markets. This to me is like multifamily 2010. And it's the same sort of demographics, right? In 2010, you had the millennials and they were about to explode. Now you have the baby boomers and they're about to explode. And that's the impetus for these markets. So the COVID, tragically for the people that have had to weather that storm, you know, it's now even a better investment because we're seeing people that just are tired. They want out. COVID really took a lot of capital. They're down to their reserves, and it's just caused a lot of difficulty occupancy wise. I mean, let's face it, these places turnover is 18 months average. So you close the door on one of these facilities and the government required them to, literally lock down for 9 months. You've got half your building is empty now. And you can't release it. So they've been impacted way more than multifamily or almost any other asset class, even more so than shopping centers, I think.
It's very interesting, and yet there's this enormous, you've used the term tsunami of aging population.
Right.
Like there's actually a term for, when I was in Japan, that had this also, in the early 90s, during the night, this kind of ballooning segments of the population. I think they called it the silver tsunami. Right? The silver hair, like I have over here.
Japan's a classic example. Japan was the classic example that happened 20 years ago, right? So it's right there.
And yet there's this enormous wave of demand coming towards us. Join. What's important, right, is that this is a brief moment, at least because of COVID, for depressed prices in an asset class that has tremendous demand and sustained demand over the next few years. Now, are you looking at when you talk about Class A, are you looking at value add deals, or are you typically just looking for yield coupon clippers for your investors? What are you looking for exactly?
Great question. Both. So what we're finding out there is there's what we classify as heavy value add, almost redevelopment. Some of the assets that we're acquiring are going to need a very heavy lift. When I say very heavy lift, we're talking 40, 50,000 a door, major redo, right? Almost like a new development, except it's already built and it already has some occupancy, maybe 30, 40% occupancy, right? Those we classify as a redevelopment. Our strategy there is to execute on those in a 3-year hold period, get them redone, looking like brand new, fully occupied, meaning fully stabilized in this asset class is like 85%. So at your 85, that's at like the 95 for multifamily, right? And so once we get there, then we can either recapitalize them or sell them. But we're underwriting those at least a 25 IRR.
That's extraordinary.
Over a 3-year hold. So that's what we call either redevelopment or heavy value add. Then on the other side of the spectrum, we're looking at Class A assets that have done one of two things. They just came online during COVID.
Mm-hmm.
They've leased up obviously far slower than pro forma. They've eaten up all of their interest reserves and carry. And so now these folks are either going to have to make a capital call or they've got to try and unload them. And to unload them, they're willing to take a much lower return or even no return, just get me my money back and you take over. So we're finding some very, very nice assets, gorgeous brand new properties in that category that, that are unbelievable. And on those, we're underwriting those generally to, a 9 or a 10 and a 20 IRR. So 9 or 10 average yield over a 5-year period and a 20 IRR on the exit at the end of 5.
It doesn't sound possible.
It is. It's multifamily 2010. Think about it. Back in 2010, that's how we underwrote a deal. 10
that is exactly right.
10 and 20.
It's a really interesting perspective. Now, the other angle that you have is that you're not looking at the, correct me if I'm wrong, but my understanding is you're not looking at the ultra luxury. You're looking to bring to a middle market an affordable, a Class A experience in senior housing, but at a middle market price. So talk to me about that a little, because that's an interesting angle.
Yeah, so all of these are very heavy operational and intensive assets, right? I mean, this is a 24-hour a day operation. You've got nursing, you've got meals, you've got everything. So it's very difficult for an A property, operating cost-wise, to be any different than a C property, right? They're all going to be operating at very close to the same number if they're in the same community and so forth. The big difference is how much capital is consumed acquiring one asset over the other. So you take these brand new assets, they're selling for $300, $350, maybe even $400,000 a door. And then we can buy assets that are the heavy value add type. So we're buying one in particular and in Baton Rouge, Louisiana, and we're buying it at $85 a door. So think about it. We put another $40,000, $50,000 a door in there. Our basis is what, $130,000, $140,000 compared to the guy over here at $300,000. So there's the gap that we can provide, and our target is to be $1,000 below the competition. So if the A property is $4,500 a month, we want to be $3,500 a month, and that doubles or triples your market from an affordability point of view.
That's extraordinary. And you're finding deals. Well, we'll talk about the velocity of deals in a minute. It's a really interesting asset class. There's another asset class that you've been looking at. We've talked about multifamily briefly, and I know that you're looking to grow that side of the business. We'll talk about that. But you're also looking at hotels. Is that right, Chris?
Correct.
Tell me about what you're seeing in that asset class. Also opportunistic, right?
Exactly. So, what we've done is basically, you asked at the beginning, where's the opportunity in multifamily? I think for investors of our size, we're just getting killed by the big guys. I mean, it's just, anything that's up around an 80 or $100 million price tag, we can't compete. We can compete in the 20, $30 million deals, but that's really almost too small for us too. Why waste our time on that? So that asset class is really, really tough. We decided a while ago, demographics made senior housing sense. I think COVID now really made hotels a good opportunity. And as you alluded to before, the cap rates have not, hotels have not crashed. People think, oh, hotels, they're gone, Well, a few big major city convention hotel type, those have struggled. They're going to struggle. Some of them will survive and do very well. Some of them won't survive. They're going to have to be repositioned. But when you look at extended stay and select service, that category did very well. I mean, in many cases, those guys broke even. Yeah. And granted, they didn't make a huge amount of money, but they were able to keep the doors open, keep the staff working, pay the mortgage, and keep the asset going. And they were net positive. So those assets are still out there. But I think here again, you've gotten people that are tired. The smaller owners and operators have just decided, hey, it's time for me to move on and move to a different asset class. So we're seeing, we've brought on board an extremely talented team of professionals in this space, because it's a very niche category. You've really got to know what you're doing. And so we've brought a great team on board, and we're seeing tremendous opportunities. Here again, our target is the Southeast, Southwest. There's phenomenal opportunities there. And the returns are like senior housing, 10 and 20. Or
that's incredible.
Or better,
Now, we are early December 2021, heading into 2022. I know you have an extraordinary pipeline ahead of you. 40 or so deals we're planning to do. How many did you say? 10 before the end of the year, 40 next year. That is an incredible growth trajectory. do you build a company so quickly around something like, I know you've been doing this for a very long time, so you've got the experience. How do you do that? How are you structuring your Lloyd Jones to take advantage of these opportunities that are in front of you today?
Great question. So we start out with a separate vertical for each asset class. So we're not trying to get the multifamily folks to do underwriting in hotels and the hotel people doing underwriting in senior, right? We have standalone vertical operations that include an investment team and an operating team, right? And then, obviously we have a very strong multifamily team. We've been doing it forever. On the senior housing team, although it hadn't been a focus, we've been involved with that for 25 years. Now, we've recently, because of what's happened in the market recently, there's been a great deal of consolidation in that senior space. So a lot of big guys have been gobbling up the medium-sized outfits, and they're over. Like Eclipse, for example, Eclipse Senior Living, as of midnight last night, is over. They shut down. And so what's happening is there's been some very senior, very talented individuals that are now available to companies like me that want to get the best talent, ramp up quickly. And so that's what we're doing. We're going out and finding the best talent available. And that same opportunity is happening in hotels. So think about it, during COVID, all the big hotel guys, they cut back on executives and top talent to the bone, right? So there is an abundance of super high quality talent for senior housing and hotels that a company like ours can acquire. And those folks, I think two things. One, they like the idea of coming to a smaller company, and B, they like the idea of getting back in the growth mode, right? So, so that's the answer is, I think, vertical standalone, and then getting absolutely super talent in each individual specialty.
Fascinating strategy. Now, it's interesting. You're very modest, Chris. I know when you say they like coming to a small company. You're not such a small company, are you? So typically you raise money from institutions and from family offices. And those are typically, that's one check from one investor on one project. And in fact, based on our conversations over the last few months, you will actively go out and find assets that fit a specific investor's requirements, right? Whatever their target, they want yield, if they want growth, whatever it is that they're looking for, you'll find it, you'll deliver that to them. Today, you're moving into crowdfunding. Crowdfunding is very, very different. It presumably speaks to more, it brings you more into direction with the kind of investment strategy that you would like to do, rather than that of your investors, which has been good to you and continues to be, obviously. But given your druthers, if you are able to invest in any strategy that you wanted, meaning not a 3 to 5 year, but maybe a 10 or a hold forever kind of strategy, what would you prefer to be doing in an ideal world? Now that you're starting to think about crowdfunding, that might be possible. What would that be?
Yeah, I mean, look, I think it would be wonderful if you were able to raise the sort of capital that we would like to raise, and on a specific deal. I would say our average equity check is probably $25-30 million for one deal, right? So would it be possible to raise that much in a short period of time on the crowdfunding site or through the crowdfunding mechanism? I think that's starting to get possible. I mean, 5 years ago, it definitely wasn't. A couple of years ago, it was probably what, 5 million or something. You're the expert on this. I mean, you know more than anybody on this topic. So, but now I think it is getting to be a viable play. You're seeing Starwood, you're seeing KKR, you're seeing Blackstone, all of them going into non-traded REITs, which obviously have a big load on them, right? And they're sold primarily distributed through, investment, broker dealers and investment advisors and all of that stuff. So that's that outlet, and they're raising a huge amount of money for deals that are basically saying, I'll give you a 5% return. And so, so I think there's an opportunity here that, that if you are able to create a platform that can raise that kind of capital and put them into exceptional deals that we put our $1 billion family office or our institution in, I think then it's the best of both worlds. I think it could be enormous. And I think we're just starting to scratch the surface. I mean, I think you're right. You're seeing crowdfunding, started out in the venture capital world, and then, a bunch of these tech companies and so forth. It's now moving into real estate. You're seeing a couple of major platforms out there that are doing it, and they're doing it very successfully. And I think so far everybody's been careful, so there hasn't been a bomb, right? You haven't had some fraud go out there and hype up something and end up with a huge lawsuit and a huge SEC investigation. At least to my knowledge, I don't know that. So I think as long as that can be controlled, I think there's a huge opportunity.
Yeah, and and this is something you and I have talked about, is the growing awareness of crowdfunding amongst institutional investors. My experience of it, and I spoke to what's his name? I forgot his first name, Dorman, who is CEO at Institutional Real Estate Inc. And we had a long conversation about it. It's actually inspired by conversations that I had with you. What's going on with the institutional world and their perception, and my experience of it is, having come from an institutional background as well, is one of considerable interest, actually. And when you think about it, institutions, other than your single family offices, right, the billionaire single family offices, but your usual institutions, your pension funds, insurance companies, endowments even, they are really doing nothing more than aggregating crowd funds, right? It's people paying into their pensions. It's unions, it's members of unions, it's people paying their insurance premiums. Right. They're just aggregating the capital from the same people. At the end of the day, it's all coming from the same people. Right. And so there's definitely an opportunity, I think, for institutions to embrace crowdfunding because it allows the same investors whose capital they are deploying to deploy some other parts of that same investors, other parts of their capital maybe on a higher risk level than they do through the institution. But the benefit, let me just finish this one thought from your perspective. I've always thought this, is that if you bring individual investors into a deal alongside an institution, the institution is delevered slightly, right, in terms of their exposure because they're investing slightly less. But those individual investors have the benefit, this is what we talked about right at the beginning, of that institutional degree of research that they do. That's an extraordinary difference that Lloyd Jones almost uniquely has in the crowdfunding industry.
Yeah, no, I think I agree with you completely. And I think what's happening also when you mention these pension funds and so forth, more and more of them are trying to invest direct into retail deals versus investing in a fund. So rather than give 200 million or 500 million to Blackstone in one of their $5 billion funds, right? They're looking to buy direct because of the, of the spread between what Blackstone is going to cost and what it would cost them to do it direct. I think that you're going to see a lot of them use crowdfunding to tip their toe into this water and see what it's like to say, okay, on an individual deal basis, Do I put a couple million with Chris? Do I put a couple million with Adam? Do I put a couple million with Tom?
Right.
And start deploying capital that way. And I mean, you just read the other day about CalPERS, one of them, where they're now allowed to use leverage. They're going to leverage.
God, you're kidding.
Their money in order to get to an 8% return, because their pensioners need 8%. So, and they're not coming anywhere near 8%. So the article I read basically said that they're going to deploy more of their assets into alternative investments, of which real estate investments one, right? And then they're going to leverage that so that they get more of a bang for the buck, so that they can they're taking more risk to get a higher return, which they're going to have to get in order to pay the retirements to these people. So I think if you're crowdfunding, and like you said, if we can do that and have them invest, so say CalPERS comes in with one of my deals, and I have a major institution in New York, but chances are they're already invested with those guys. They invest with them, and then they turn around and invest with me. So, so I think sooner or later, people are going to get smart enough and say, I'm going straight to Chris.
Exactly.
So that's
well, Chris, you know what? Making the move as you are from the institutional world, not obviously a whole move, but you're absolutely one of the true visionaries in this industry. And unfortunately, we are coming to the end of our time together today. Let me ask you 3 rapid fire sign-off questions, if you don't. But sorry, I've already asked you these, but just quick questions I ask all of my guests. First of all, the first question: what are the key daily habits that you have that make you successful and productive?
Get up early. So I'm up usually 4:35 a.m. every day. I go for a jog every morning. And then, I try to, during the jog, I'm thinking. I seldom listen to, to the tapes and so forth, but most of the time I'm thinking about what the strategy is for the day. What are my top 3 that I have to accomplish today? And I got to tell you, I think getting up early, getting outside. I hate the gym. I like to be outside, even if it's raining or whatever. Then again, I live in Miami, right? So I'm not in New Hampshire, but that's a key to me.
Second question, Chris, what has been the hardest lesson you've learned in real estate throughout your career?
Wow, that's a tough one. I would say, I would say leverage. I mean, when we started out, we probably, in a lot of our deals, over levered. Thank goodness we survived, but markets can turn down a lot more than people expect. And as I said earlier, if you can hang on, it always comes back, and it always goes higher than before, which is amazing to me, right? So, but you just can't. I think over leverage is where I've been bitten a couple of times, and I'm not planning on doing it again.
Last question. For an individual investor who has the opportunity to invest, perhaps with Lloyd Jones, a small amount of money in a crowdfunded deal, for the first time, they've never invested in real estate before, what advice would you give them if they're thinking about investing in real estate this way?
Well, it's a people business. So the most important thing you've got to consider is, who are you investing with, right? So that's the main question. Who is the person that's making those investment decisions? What's their experience? How long have they been in the business? You're investing with a person. I mean, you may bring a real estate deal to me, but more important than the deal is you. How have you underwritten it? How are you going to manage it? Those are the most important questions, is who is the operator, basically.
Look, it's people that count.
Exactly.
Yeah. Chris Finlay, CEO and founder Lloyd Jones. It's really been an enormous pleasure getting to know you, Chris. Thank you so much. And thank you for joining me on the podcast today.
Thank you very much, Adam. It's always been great. Thank you.
That was Chris Finlay, Chairman and CEO at Lloyd Jones. Be sure to keep track of what they are doing because they're going to be opening up their platform for the first time to individual investors, and there are very few places like Lloyd Jones where you will be able to participate alongside true institutional investors as you expand your real estate portfolio. Keep an eye on Lloyd Jones. You'll find links to Chris and to Lloyd Jones on the podcast page for today's episode at gowercrowd.com, where I encourage you to sign up for our newsletter. It is the only resource of its kind that focuses exclusively on the real estate crowdfunding industry, and it is totally free. So it's priced right, at least, and it covers all the latest news updates and information that you could want on the industry, all there at gowercrowd.com. Chris Finlay, thank you so much for joining me today. It means a lot that you did. It's really been a pleasure getting to know you. Thanks for being my guest. And thank you too for listening in to this episode today. That's all that I have for you this week. Be well, stay safe, and for now, this is Adam Gower signing off.